Everyone is talking about deductions in 2025, but very few people understand where the real write-offs are because the biggest tax benefits under Trump Big Beautiful Bill are not loopholes. They're not tricks. They're structural changes on how depreciation and expensing works. And if you don't understand them, you either miss them entirely or use them the wrong way. Today, I'm going to walk you through the most important write-offs you need to understand, how they actually work, and why timing and structure matter more than ever. If you haven't met yet, I'm Alex, a licensed CPA and owner of Save Accounting. We work with business owners and high-income earning professionals who want tax planning that's intentional, defensible, and strategic, not just aggressive. At Saba, we don't just ask, what can you deduct? We ask, what happens after you deduct it? That distinction matters a lot under the current law. Before we talk about specific write-offs, let me explain this simple concept. A write-off does not magically make something free. It accelerates or shifts when you recognize an expense for tax purposes. Trump's Big Beautiful Bill made three major things permanent or expanded: 100% bonus depreciation, a dramatically expanded Section 179, and a new category, qualified production property. These change when deductions happen, not whether they exist. Let's break this down. Number one, bonus depreciation allows you to deduct 100% of the cost qualifying assets in the year they're placed in service. This applies to most tangible business property with a recovery life of 20 years or less. Things like equipment, furniture, machinery, computers, vehicle used for business. Let me give you a simple example. You buy $100,000 of equipment for your business in 2025. Under normal depreciation, you deduct that equipment over several years. Now, with 100% bonus depreciation, you can deduct the entire $100,000 in year one. And if you're in a 30% combined bracket, that's roughly $30,000 in tax savings this year. But here's the piece that most people miss. You didn't create a deduction. You just pulled it forward. That means that future depreciation disappears. Future taxable income may increase and cash flow timing becomes critical. This is powerful, but is dangerous if used blindly. All right. Number two, Section 179 lets you elect to expense certain assets immediately, similar to what we just spoke about. Under the new law, the limits jump significantly. In 2025, up to $2.5 million can be expensed, and it begins phasing out once total purchases exceed $4 million. Unlike bonus depreciation, Section 179 is elective. It can be applied asset by asset, but it cannot create a business loss. Let me give you a quick example. Your business earns $500,000. Then you buy $800,000 worth of qualifying equipment during the year. However, you cannot deduct the full $800,000 under Section 179. You're capped at your business income, that is $500,000, and the rest, in this case, $300,000, would be carried forward to future years. Now, compare that to bonus depreciation. Bonus depreciation can create a loss. So the strategy in this case isn't which is better, it's which one fits your income, your cash flow, and the future plans. Okay, on to number three, vehicles are the most misunderstood write-offs. If the gross vehicle weight rating is under 6,000 pounds, strict annual depreciation limits apply. If the gross vehicle weight rating is over 6,000 pounds and it is used primarily for business, those limits largely disappear. For example, you buy an $800,000 SUV over the 6,000 pound limit and is used 100% for business, you may be able to deduct up to $31,500 under Section 179 and the remaining balance using 100% bonus depreciation. That can result in a full deduction in year one. But, and this matters, business use must stay above 50%. If it drops below that later, depreciation recapture may be triggered and cause ordinary income. On to the next one, number 4, qualified improvement property. Improvements to the interior of non-residential buildings, HVAC, electrical, plumbing, roofing, now qualify for accelerated expensing. This is huge for restaurants, medical practices, offices, retail spaces, and many others. Let me give you a quick example. You spent $100,000 upgrading your HVAC and electrical systems in your office. Under prior rule, this might have been depreciated over decades. Now, this may be eligible for immediate expensing under Section 179 or bonus depreciation. That is not a loophole. That is Congress explicitly incentivizing reinvestment. Next, number 5, qualified production property. This is a sleeper in the provision. Under the Big Beautiful Bill, certain manufacturing and production facilities may qualify for 100% immediate expensing, even though they're real property. That is unprecedented, but also is very, very narrow. It applies only if the property is used directly in manufacturing or production, construction or acquisition falls within specific dates, and the use is integral. It is not to be used for admin, office, or retail purposes. Let me give you one example. A company built a $3 million manufacturing facility that qualified. They may deduct the entire $3 million in 1 year, but if that facility is later converted to rental or non-production use property, then the full depreciation recapture would apply. This is not a casual deduction. This is a strategic long-term decision. Let me explain to you how this all fits together in order. First, Section 179, which is elective, then bonus depreciation, and then you have maker's depreciation, which is the standard depreciation that we're all used to. And every one of these affects your cash flow, future taxable income, your exit planning, financing, and your risk exposure. This is no longer about maximizing write-offs. It's about controlling the timing. Here at Ceiba, we don't chase deductions. We model outcomes. We ask, what happens next year? What happens if income spikes? What happens if you sell? What happens if the business use changes? Because a write-off today can become a tax problem tomorrow if it's not planned correctly. That is the difference between preparation and strategy. If you're a CPA, it's only talking about deductions after you buy assets, you're being blindsided. These write-offs reward planning before the purchase, not after. If you want tax strategy built around how the law actually works, schedule a strategy call with Save Accounting, because the biggest write-offs aren't hidden, they're just misunderstood. If you like this video, please drop a like and subscribe to continue creating content like this. I'll see you in the next one.